Let's invite an expert in the field, Jerry Lee from TurnStructure, to come onto the stage to share on the keynote topic of fixed income protocol, fuel the coming bull market with hundreds of new use cases. Let's welcome Jerry.
Thank you, Sharon. Good afternoon, my friend. Next 20 minutes, I'm going to introduce you what is fixed income protocol, and then I will share with you the new use cases that we can leverage fixed income protocol in DeFi. You may wonder why we call term structure. What does that mean? Term structure is actually financial terminology that is actually telling you the relationship between the fixed interest rate and the time to maturity for bonds. So if you plot this relationship on a chart, you will see a curve. We normally call it yield curve. So with that yield curve of like so-called term structure of interest rate, let's say for example in US dollar, without that, we won't have a fixed income market in US dollar. Without that, we will not have a US Treasury market. Can you imagine? The whole financial market will collapse. But today in DeFi, we have no idea. We don't know how important it is. Okay, so let me just go through with you. So the following first 3 pages, I will talk about term structure, who we are and what we do and why we do it. And then the last 4 pages, I will share with you the different use cases. This is a slide I used second time in my speech. This is very important. We have to know where we are today during this product complexity curve. Or we need to know where we are today throughout the evolution of DeFi. Today, we're very happy we have a money market protocol, which is like a RV compound. They are successful. And you can deposit your tokens, or you can borrow the loan, a debt from that pool. But on the other side of curve, at the end, we see options and the structured products. There are some success cases there, but if you look at the middle part of the curve, this is a gap. There's nothing. So if you want to see the organic growth of DeFi in the next couple of years, the first thing we need to do is to build fixed income market. So with this fixed income market, then we can figure out what is the discount factor to use for the 6 months or 12 months cash flow. And with that, we will be able to find the interest rate parity so that we can build the market for other derivatives, including interest rate swaps, forwards, and term futures. On the other hand, if you believe tokenized real-world assets is going to be the next big theme in DeFi, then we should definitely focus much more on the fixed income market. Why? Because with those RWA tokens, what do you want to do it on-chain? You want to put it in your cold wallet, or you want to use that for financing and to leverage, or to use to manage your duration for the asset and liability on your balance sheet. So there are many use cases that we can use that. So I will show you later. Okay, so fixed income. This is a very special product in financial markets where it has a maturity date and it's cash. Right? So this is not a leverage product like options or futures. So to build fixed income markets, we've seen like many people try, but we don't see much, like we don't see many successful cases. So what we're trying to do is like we know that we should not use peer-to-pool. The peer-to-pool, if you can think of that, in our pool, we have 4 billion of deposit, but the pool only lend out 1 billion. The 1 billion borrower pays 4%. the 4 billion depositor will only get 1%. And if you think if we apply this to 1-year bonds or fixed income tokens, so the 1-year borrower will pay 4%, and the 1-year fixed income token lender will get only 1%. How can this market survive? So we need to think. We will try and we will think a way to use peer-to-peer. Okay. And then the other things to think of the automatic market maker. Should we use that or not? Automatic market making process will give you a price. You can only choose to take it or leave it. For fixed income, every single cent counts into your interest. So you want to place order. You want to decide the price you want to pay or receive. So we should build up order book for fixed income, not an AMM for fixed income. So a scaling solution is important. And we don't want to pay gas fee for any order placement or cancellation without any transaction done. So we choose to go with DK. We decided to use DK rollup to make sure our users' asset can be secured on chain. So we developed the auction process in our primary markets for lenders and the borrowers to use that to lend or borrow fixed interest rate at fixed term to maturity. And we also built order book for secondary markets and the repo markets so that the people can trade the fixed income tokens on this platform. If we look at this, why we use this ZK true up that we develop our own? Actually, somebody asked me before that why don't we use the other public layer 2 ZK chain? We did consider and we struggled, but after thorough considerations, we decided to develop our own. So the first we are thinking of is the liquidity. We want to have direct access to Ethereum, where it has the biggest TVL. And the most DeFi ecosystem is on Ethereum. So that we will be able to build our DApp with compatibility with other DeFi protocol. For example, that we can have our users to use flash loan. We can have our users to roll the debt on term structure directly to Aave. And we have a liquidation process, which is similar to Aave in Compound, so that the liquidation bot can help us to protect the protocol's safety. And we also consider the interoperability. Because we are using ERC20 token, so our user, when they withdraw, they will withdraw directly to Ethereum. And then they can use this token to interact with other wallet service provider or RWA service providers. So this is the ERC token, and then this is the liquidity consideration we have, so that we build fixed income on Ethereum first. But the next phase, we're going to move on, of course, to other ecosystem on other chain. But if we are doing the derivatives, I will probably do the other way around. And then the fourth item is the scalability, that this is our consideration, because we don't want our users to pay gas fee on L1. And we don't want our users to pay the layer 2 fee just for the order placement. So that's why we build on our own, so that we can make a decision and what is the gas fee or transaction fee arrangement. And our user will feel like they are doing the transaction on centralized exchange. The next is flexibility. Because ZK rollup is the core technology of our products. So we needed to consider this flexibility for the business requirements. For example, we built forced withdrawal. We built evacuation mode on our ZK true-up contract so that we can make our own decision, what we want to do, and then what is the best for our user. And for certainty, this is another important factor that we consider when we make decision about 1 year ago. Because this is the core techniques, as I mentioned. So we need to make decision on our own development timeline, cannot be decided by the third party. So if we do that a year ago, we will probably won't be here today. Okay, so the following 4 pages I will go through with you to share with you the use cases. So this is the first one. If you are a lender, you may want to have a fixed interest rate, and you may want to have the certainty of our future cash flow. So this is the stablecoin like lending rate on compound. As you can see, it moves. We already have some of the fixed income protocol in market. They all come with different platform risk, different rug pull risk, different credit risk, and a different return. So look at that. And on term structure, you can decide what interest rate you want to lend on your own. And if you are a borrower, you can take a look at this blue line. The blue line is the implied interest rate from the CME Bitcoin futures maturing on the 26th of December. And then the yellow curve is a Bitcoin variable borrowing rate on Aave. If you are running a trading strategy based on that, the Aave rate, you might get knocked out on your strategy when the interest rate shoot up to 46%. So if you're a borrower, if you're running trading strategy, you may want to have a fixed interest rate as your funding cost. So you want the certainty on the cost of fund. And if you can borrow the fixed rate at the range between, let's say, 2% and 9%, then you can do arbitrage. You can do trading against the other platform for the fixed interest rate. Okay, this is the second use case. You may need a little bit more financial background to understand this page. So this is for stablecoin liability management. If you are a central bank, you may have an idea where is the interest rate range you would like it to be for your own currency. And the stablecoin issuer, they are not central bank, but they have the same agenda. They want to keep the interest rate of their currency or stablecoin at a certain range. They want to keep their currency and the stablecoin stable. So, what if I were a stablecoin issuer? What I will do is I will come to term structure to borrow 1 year at 5%, so that I can lock in the liquidity for 1 year from street. And then I can decide to borrow 6 months at 3%, 2 months at 1%, so that I can build a yield curve. And that will be the dynamic flow of my stablecoin. And if interest rate goes up, let's say, for example, if 1 year of my stablecoin fixed income token goes to 10%, I can buy it back. Or I can deregister it, just like what commercial banks do in our real world. So if we do that, then effectively, we are setting up a cap in the market so that I can make sure that our interest rate of the stablecoin fall between this range. And the most importantly is this will help us to keep our stablecoin stable. And this is going to keep us, like our stablecoin, to avoid being 100% of our liability being current liability. So we can turn 20 or 30% of our liability into term liability. So this is very important for any commercial banks and or for any financial authorities to do that. The next use cases is fixed rate financing for tokenized real world asset. Right now, we've seen multiple different kinds of tokenized real world assets. Maybe I will take an example of a real asset. So if you have a house, what would you do? You will do the mortgage. You want to borrow fixed interest rate, and you want to borrow fixed term, so that you can use this money to do something else. But what if you tokenize the certificate of your house to a token on chain? If you're not selling it, what will you do? You want financing again, right? So do you want to put it on some protocol like Aave or Compound to borrowing a floating rate? Or you want a stable cost of fund to borrow 1 year? You can think of that. So if there's any like interest rate volatility comes up, you don't know, you will suffer from the high interest rate, but you don't know you will suffer for how long. So this is the beauty of the fixed income. And if you believe there will be $1 trillion market in RWA in the coming 3 to 5 years, then fixed income is the must for being infrastructure. And without fixed income, I don't think the RWA market will go that much, because whatever tokens comes into RWA will drop into the cold wallet. Okay. So there's one more page I wanted to share with you. So there are other more use cases, a lot more. I just take a few examples, right? If we put a put option together with the fixed income, then you can create a dual token investment. That dual token investment is what we do, right, in real world, so that so many people are doing the dual currency investment with the banks. This is the same thing. And that put option is actually can be another hedge instrument for the term borrower to hedge to avoid being liquidated. And the other thing is the perpetual futures. If we use that to combine with the fixed income products, we can create the floating rate structures. Some people love to have this because the perpetual futures implied yield is normally higher. And there's always a certain period of time in a year you will see very high. And they get very high coupon from these fixed income structured products. Or we can overlay with options. If we overlay with options, you can create the different kind of a payout on your structured products or the investment you can have. Or if we put two different fixed income curves, we can create a forward price. So for example, if we have a ETH 3 months price, and if we have USDC 3 months price, with the both fixed income curve, we can create the 3 months ETH versus USDC forward price, so that you can hedge. When you move in, when you want to buy ETH, you can hedge ETH with USDC, right? So with that function, you may attract more TradFi money into DeFi. Right. Of course, there's some others. I cannot tell you everything. Right? Maybe I can just add one more. That is the payment. If there is a supply chain payment, you need to pay something, $100, 3 months later. But what are you going to do pay today in crypto? You can only pay $100 today. But actually, with the fixed income token, you only need to pay $95, because you can use $95 to buy the fixed income token and use that as a payment, medium of exchange. So that 3 months later, then the receiver will receive $100. This is what we can do. So that's why I'm saying that this fixed income protocol is the fuel of the next round of the bull market in DeFi. Thank you.